and then it's like, oh my God, the Fed aren't going to cut rates. That's the end of the market. They can't, just so much noise. What I urge people, I wrote it, I think, in response to you, Ovi, is 2017-16 was a near identical setup. So the market has been following the pattern, but outside of that, Trump got elected. Everyone went, oh shit, tariffs, they're inflationary. The dollar screamed higher, rates went higher. And then what happened was Trump came in and said, we need to get a lower dollar. Scott Bessent's already talked about it. The other guys coming in as the Economic Council guys already talked about the dollar being a problem. So I think they're using the dollar as the stick and will then offer it as the carrot to the Chinese, the Canadians, the Europeans, and everybody else, which is, if you agree a trade deal with us, we will help lower the dollar. The dollar is a function of liquidity, which is why rates are so bad as well. There's actually not enough liquidity in the system. And I think that's sort of somewhat purposeful overall. But if we go back to 2017, and we had that setup of the dollar turning over and then rates actually came down for the rest of the year. The other thing, the Fed were raising rates all of 2017 and crypto went up.
Yeah.
USM2 went down. So all of the things you would be looking for, they were all in reverse. So what really was happening in 2017 was China had been beaten up by the strong dollar in 2015, 2016, and their economy was super slow. China increased the balance sheet and the Fed lowered the dollar. The Europeans did some QE and the UK did some QE. We got a near identical setup. The market is over extrapolating tariffs and fears. Whatever rates do is irrelevant. It's what global money supply does, not global money supply, global liquidity does going forwards. We know back in 2017, the Treasury drained the TGA for the same reason. I mean, it's like literally everything is an exact rerun of what happened. So, look, I don't expect an exact rerun this time, but probabilistically speaking, there's nothing to be concerned over. Now, when we looked at that big M2 drop last time around, and this time around, it leads by about 12 weeks. So last time around, we had an identical M2 drop. You can see it. I don't know if you can share that chart you're looking at now after that one. So this one shows the near identical pattern in M2 back then versus now. What happened was the dollar weakened, global M2 went up. What also happened is the NASDAQ had a similar correction, crypto very similar. And what crypto did was didn't follow M2 going forwards because it starts to decouple as the bull market takes place. And what happened was it did an 8-day correction and did negative 35%. This time, it feels like it's slightly more sideways. Whether it goes a bit lower or not doesn't really matter. But the point being, you're looking for the bottom as opposed to a sharp acceleration from here. But either way, it's over pretty quickly. And then what happened last time around is the moment Bitcoin hit a low, alts took off. And so that's my general thesis on all of this right now. This is pretty much playing out exactly as I've been expecting it to play out. And whether that's in liquidity terms, because it's a rerun, because we've got this debt cycle, it's the same bloody thing, right? So that's my overall view. It's like, it's all fine.
Raoul Pal, the macro mastermind and CEO of Real Vision, has just shared his insights about Bitcoin's startling resemblance to its own historical pathways. Imagine the crypto giant poised to mirror the rhythm of its legendary surge from nearly a decade ago. But what does this mean for the market? Before jumping to conclusions, let's consider what this could spell for both seasoned investors and the curious rookies in the stock trading realm. Join us as we navigate through this fascinating narrative, highlighting insights from influential minds and major economic indicators. Welcome back to Investocracy Crypto.
When we look at Bitcoin, we can see the phasing's out, but when you kind of match up the phasing, what happened, it was the 4th of Jan, we had a correction like we're having now, and then Bitcoin went up. And once you match the two, you kind of get a very similar pattern. So what we've got is, and also here's the economic surprises index and the DXY. It's been coming lower. it should drag the DXY, change rate expectations. Julian just put out a tweet this morning about all of that. So everything is here. Fed cuts may change because there's now like 25 basis points priced in. Okay, as a risk reward, there's a decent chance we get something. So it's like all the factors are in play, and whether the market sniffs it out or not, I mean, we got another week until whether we get fuller announcements beforehand or we have to wait for the inauguration and stuff. I don't know.
I think Scott Besson speaks on Thursday.
Oh, really?
It could be an obvious timing to say something. It's the first time that he'll say something in public, as far as I'm concerned. Then we obviously have Jay Powell as well, right? Not sure whether he wants to say a whole lot this week. But anyway, it's kind of a waiting game in many ways. And you're absolutely right. Good old friend Jim Cramer was out this morning saying that we'll have a complete washout. I'm very thankful that he said that because I'm pretty heavily invested in the crypto story myself. So in any case, Raoul, I want to show you a chart on Bitcoin. And it's a very homemade technical chart trying to depict what I consider the consensus around Bitcoin right now. We've had a lot of discussions ongoing from technical analysts around the head and shoulders pattern. I know you've also discussed that with various pundits within the crypto industry. And to me, it seems like the consensus that we'll have a leg lower towards, say, the 70K to 80K range before we stabilize there and get that second half of the year rally. Do you think that's a feasible technical setup here? Or how do you see the Bitcoin story playing out amidst this strong dollar?
So using the parallel of 2017, I think the bottom is in. I think it happened today. Now, the other outcome would be the outcome you've shown me. Yeah. But my base case is that using the historical parallel, I think we probably put the low in. I mean, Bitcoin's price action, was ugly today. Let's wait and see. Not that I'm not buying, not selling, not doing anything, but it's either your outcome, which is a sharper fall for longer, in which case it's fully mirroring the M2 drop, or it does what it did last time, which is it prices in the first part of the M2 drop and then dislocates. And it tends to dislocate the rest of the year because there's more speculative flows in the final year. Liquidity should come in. So that's my view.
The plot thickens as Raoul Pal, the ex-Goldman Sachs executive, finds himself drawing comparisons between today's market conditions and those pivotal to Bitcoin's bullish run of 2016. Back then, Bitcoin was the plucky hero of the digitized financial frontier, valued at a modest $1,000 before embarking on a meteoric rise to $20,000 the following year. So, what has changed? Or better still, what remains the same? Raoul emphasizes that though history may not exactly repeat, it does often rhyme. This poetic parallel has many wondering if we're on the brink of another dazzling display of cryptocurrency prowess.
And I guess this drop in M2, Raoul, I've had plenty of questions on it from the audience. It's very dollar-driven rather than driven by actual M2 developments, if you know what I mean. It's a conversion thing. And I tend to see that as a less strong signal than an actual drop in M2, right?
Yes, there's nobody's withdrawing liquidity except the Fed, which is the dollar issue, right? And so even though, the Fed have been neutral with liquidity, but the dollar's got stronger. So dollar liquidity in the system is the issue. As you rightly say, nobody else is withdrawing liquidity. Everybody's trying to add liquidity. But the dollar is kind of overwhelms everything right now.
Yeah. And speaking of the US dollar, we've already had a few questions on the good old pound sterling, Raoul. What a nasty trend we have in the cable, right? And it's been another very weak day.
Pulling up my chart one sec.
Yeah.
Carry on.
You don't check the sterling every other day anymore, Raoul?
No, never. I don't even care about it.
It's your good old home currency, right? But it looks very nasty. And to me, it's kind of the picture perfect setup for a liquidity addition in the UK, what we're seeing right now. Bond yields are going up and the sterling is going down. And it looks like the market has sort of called the bluff on the Keir Starmer administration in terms of their fiscal capacity, in a sense, without the Bank of England playing ball on the liquidity side. So I actually think it's a very good trade to be short sterling still. It's one of the trades that I hold a high conviction in. But it's also a very consensus view right now after what's been ongoing. But what do you make of the malaise in the UK? Is it something that's on your radar at all?
It is and isn't. The one thing I am looking at is it has been the canary in the coal mine for the bond market. The UK seems to have the worst liquidity of all of the major bond markets. And if I look at on Bloomberg, the gilt liquidity index, it is now continually trading higher than the Liz Truss, gilt intervention. So it cannot be escaping the central banks that inflation expectations are stable, and yet yields are exploding higher. And again, right in your wheelhouse, it is telling you, screaming at you, there is not enough liquidity. Now, and understand they're scared because they've just gone through that inflation episode and everybody's still angry about it and whatever. So they're reticent to do something. So they're trying to hold on as long as possible before injecting liquidity.
Raoul's statements dovetail neatly with data from the global M2 metric, a broad measurement of money supply flooding the worldwide economy. This crucial indicator is echoing patterns seen during the spectacular Bitcoin ascension of 2016 to 2017. The implications? A potential surge in crypto value that might have us reminiscing about previous historic upswings. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
So the answer to inflation is having bond yields what they're doing. I still think by the end of this, inflation will undershoot, not overshoot, because of the weird dynamics that caused by the pandemic, and this lagging of housing and rates being so high for so long. It doesn't affect Microsoft and Apple and Google or whatever, but it sure as hell affects anybody on a variable rate mortgage or anybody who's borrowing money elsewhere in the economy. But it takes time.
With Raoul Pal's insights paving a hopeful path for the crypto king, investors are tasked with making informed decisions, perhaps witnessing the dawn of another bull run. With market conditions aligning, forecasts suggest a continuation of this upward trend, propping Bitcoin in a strong position as the digital beacon of growth. But what are your thoughts on Bitcoin's potential surge? Will you jump into the fray or watch from the sidelines, waiting for the right moment to act? Share your thoughts. And finally, if you would like to know more about cryptocurrencies or specifically Bitcoin, go ahead and click on the next video on your screen. See you there.